In this video, we'll be discussing 5 types of index funds. We'll talk about the pros and cons of each type to help you determine which one may be the best fit for your investment goals. Index funds are used by passive investors, but an index fund can also be a part of an active investor's portfolio if he's looking for a low-cost and diversified way to invest. But index funds have gotten a lot more complex since Jack Bogle created the first one in 1976. Investors can now use them to gain additional exposure to certain markets, sectors, or even investment styles. A broad market index tries to capture a large part of an investable market. And typically, they have some of the lowest expense ratios, so that is something to take into consideration. If you're looking to get the most diverse basket of stocks, a broad market index fund is for you. But you have to remember that if you are planning to invest in other index funds, you may face some overlap with your holdings. And these are some of the examples of broad market index funds. If you want to diversify geographically, international index funds can provide that. And they work a bit like broad market index funds, but they concentrate on companies in different parts of the world. But international index funds aren't necessarily grouped geographically. You can also buy funds that track indexes in emerging markets or frontier markets, which aren't tied to a specific geographic region. And these are some examples of international index funds. Most broad market index funds are weighted by market capitalization. So the biggest companies take up the biggest part of a particular fund. And that could leave you with little exposure to small and mid-cap companies. And smaller companies historically outperform larger companies over the long run. But of course, they can have greater volatility. So investors with a longer time horizon could benefit from greater exposure to small and mid-cap companies. Index funds based on market capitalization can allow you to do just that. And these are some examples of market cap-based index funds. Index investors looking for dividends from their portfolio can buy dividend-focused index funds. There are two main types of dividend indexes: growth and yield. Dividend growth indexes include companies that constantly rise their dividends and have the potential to keep doing so in the future. Dividend yield indexes include stocks with relatively high dividend yields. Dividend index funds can be great for investors looking for regular income from their investments. But reinvesting dividends in dividend growth companies can in the long run be very profitable. So you have two options with dividends. And these are some examples of dividend-focused index funds. If you want to invest in a specific sector of the market, for example, finance or real estate, sector index funds are exactly what you are looking for. And sectors themselves can be divided into broad, for example, technology, and specific, like cloud computing. Investors that want to gain exposure to an industry trend, but don't know exactly which company to bet on, can invest in a sector fund, letting the market figure out which company is the winner. And these are some examples of sector funds. So if you are considering investing in index funds, I hope this video was helpful. But if you only want to invest in individual companies, then a video about the best free websites for investors can be interesting for you, and you can find it here. If you want to watch something else, then click here. Thanks for watching, and bye-bye.